Mortgage rates dip to 6.74%. What it means for home buyers in 2025. Dreaming of home ownership? Brace yourself. Mortgage rates remain stubbornly high, crushing affordability despite a microscopic drop this week. Yes, the average 30-year fixed mortgage rate dipped to 6.74% from last week's 6.75%. But here's the brutal reality the prospective buyers can't escape. Those hoping for meaningful relief face record-shattering home prices that transform even this slight decline into a cruel mirage of affordability. Let's break down why this tiny shift changes almost nothing. Compare today's rate to last year's 6.78%, and you'll see borrowing costs remain painfully elevated. Even the 15-year fixed rate, popular for refinancing, saw a negligible drop to 5.87% from 5.92% last week, down from 6.07% a year ago. Both moves are statistically insignificant when you're staring down median home prices nearing $500,000. This isn't just unfortunate. It's paralyzing the entire housing market since 2022, creating the worst sales slump in a generation. Sales of existing homes crashed to 30-year lows in 2024 and remain frozen solid this year. Why? A double vice. Skyrocketing prices meet mortgage rates so high they make ownership financially impossible for countless Americans. But here's the twist many overlook. These same high rates trap current homeowners too. Millions refuse to sell because they've locked in pandemic-era rates below 3%, creating an inventory crisis that worsens price pressure. What actually drives these rates? 3 heavyweight factors: Federal Reserve policy, bond market sentiment, and inflation expectations. The 10-year Treasury yield acts as the mortgage market's heartbeat, currently at 4.41%, barely changed from Wednesday. But here's where it gets controversial. Yields keep climbing because traders bet the Fed will ignore former President Trump's public demands for rate cuts and hold firm at next week's meeting. This raises a powder keg question. Should politicians influence central bank decisions? Critics warn that pressuring the Fed risks its independence, which could ironically backfire. While lower short-term rates might help credit card or auto loan borrowers, they might actually push mortgage rates higher by spooking bond investors. One glaring contradiction hangs over this market. Though rates eased slightly, they hovered near January's 7% peak all year, with April's 6.62% being the lone exception. So we must confront an uncomfortable truth. Today's slight dip is merely a blip in a relentlessly expensive landscape. Now we turn to you. Is this the new normal, where homeownership becomes a luxury? Should the Fed resist political pressure, even if it prolongs the housing crisis? Share your take below. This debate affects every aspiring homeowner in America.